Hey, Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. Thank you for being here for another Beer Money Sunday. Love these, love these informal live streams, these chats that I can have with all you out there in the nation. Hope you got yours wherever you're at in the nation there, adult beverage or otherwise. Feel free to drink a little bit of coffee. I know it's pretty late there in some parts of the world, so we're just gonna get started here. Again, thank you for being here. Let me know where you're coming at from the nation out there. I already see a lot of great members of the Bowtie Nation out there. Neil, Brian, Ambrose, Fisk, all the way from Somalia. So thanks for joining us. Love doing these informal live streams every week. Just kind of a chance to relax, take off the bow tie, and talk to you about investments. Let me know. Make sure that you can hear me, see me all right, and we'll get started here. Because a really important video for you today, alternative investments and really the investor questions around those, probably more important than you realize. Alternative investments, alternative assets are all around us, and Main Street investors have never had more access to this asset class than right now, right? But most investors really don't understand these or don't know how they're different from other assets, other investments. They are higher risk, but also offer that potential for higher return, as well as some of the other characteristics that are really going to drive your portfolio. So love talking about these, and I'm going to be sharing my own portfolio, how much I have in each of these alternative assets, along with how much you should be investing, and kind of how to play that. Before we get started there, I just want to, send a shout, try to, personally invite you to the Bowtie Daily. That's our daily market update newsletter. Goes out 9 p.m. the night before the market opens every night, and just some great news, strategies, trends that I'm following, just everything you need to really start your next investing day. It's totally free, just something I like to do for all you out there in the nation. So pinned a link there in the live chat. If you're coming in later, then I'll also put a link there in the description below. Click through. Like I said, it's free. Just sign up and you'll get that daily Bowtie market newsletter every single day before the market opens. But I want to get to it because, like I said, this is a really important topic for you today. Really, how to play these and some of the pitfalls, some of the traps I see a lot of investors falling for in these alternative investments, alternative assets. And then, of course, we'll have Q&A at the end of the live stream. Always my favorite part of the live stream, just being able to connect with all you out there in the nation. If you didn't catch last week's videos, make sure you check those out. Showed you how to create that monthly dividend income from those monthly dividend stocks. Always a really popular topic here on the channel. Showed you exactly how much you have to invest for whatever amount you need on a monthly basis to pay your rent or your bills or whatever. Also talked about some penny stocks, 10 penny stocks under $5 on Friday. Hugely popular subject as well. Next week, we're going to be talking about genomic stocks. This Monday, actually tomorrow, got a video out on the 5 best genomic stocks, one with estimated growth of 35,000% over the next year. So really some amazing growth and opportunities in these gene editing, genomic, and cancer screening stocks out there. So make sure you catch those. And then Friday, actually, a video coming out, the highest yielding dividend stocks. So not necessarily those monthly dividend stocks we talk about a lot or some of the other dividend stocks, but the very highest yielding dividend stocks in the market. So make sure you catch that. But I want to get to it here because these alternative investments, again, a huge opportunity. And really part of that is that Main Street investors have never had more access to these kinds of assets and these kinds of investments. It's been ever since the 30s, the Securities Act of 1933, after the big crash there. Then the government came out with this new rule that said, you got to be rich. You got to be a millionaire. You got to have a portfolio of over $1 million, net worth over $1 million, not including your house, or be making, something right now it's upwards of about $250,000 a year just to invest in a lot of these, to have access to a lot of these alternative investments that we'll talk about, like private equity, hedge funds, venture capital, which is, where I used to work as a venture capital analyst. And I saw the returns in these stocks or these assets, these investments for so long. And it's part of the reason why I started the blog, started the YouTube channel, because I really wanted to bring, that level of analysis to Main Street investors because you've never had access to that kind of a rich people analysis, rich people market before. But over the last few years, it's really opened up through whether crowdfunding or some of these other currencies, private equity, hedge funds. A lot of them are starting those ETFs where you can access these types of investments. So I really wanted to talk about this because a lot of investors don't really understand or realize that these are a distinct part of the market and a distinct opportunity with their own traps and their own risks and return and all that kind of thing. So let's get started here, and with basically kind of what is alternative assets, what are alternative investments? Okay, so now assets are any kind of a grouping of investments. You think of stocks are assets, bonds, real estate, and these are just something that are expected to produce a return or a value over time, right? And each asset class reacts similarly to economic factors and has similar characteristics, okay? And this is really important because it's what separates it from other assets, okay? Stocks, highly liquid. You can get in and out of stocks really fast. They react positively to economic growth and generally positive to interest rates as well as moderate inflation, that kind of thing. Whereas bonds, also very liquid, you can get in and out of bonds fairly quickly, produce that fixed rate of return or that fixed income plus the certain cash flows over that period. But they react negatively to higher interest rates, inflation, a lot of the things that stocks do well on. Real estate, for its part, not quite as liquid, obviously. And a lot of people will kind of talk about real estate in this realm of alternative assets, right? Because it kind of shares a lot of those characteristics with alternative assets that we'll talk about. But real estate, obviously outside of those REIT stocks that we talk about on the channel, very illiquid, which means that it could take 30 days or more to buy or sell real estate if you're looking at that investment, right? Especially the direct purchase of real estate, whether it's commercial or residential real estate. High risk adjusted returns in real estate. It reacts positively, obviously reacts very well with inflation because that property value keeps its value against inflation and against a weakening dollar. Obviously does very well when the economy is doing well, as well as different real estate fundamentals or economic characteristics within that. What we want to talk about here, though, today is how these other alternative assets are different from these, and really how it affects your choice or your investment opportunity and your decision in these. Okay, so these alternative assets, and I'm going to list them out and talk a little bit about them here, but you got to understand that these are, one of the benefits here are they have a low correlation with stocks and bonds and other assets or real estate, right? Which just means that, as stocks and bonds or as stocks are going up, then, these alternative assets don't necessarily always go up with stocks or always go down with stocks when stocks crash. And it's important for that idea of diversification, right? You start adding these different assets, stocks, bonds, real estate, and these alternatives, and it just kind of smooths out your portfolio, right? So you don't freak out the next time the stock market crashes, okay? So that low correlation with stocks and bonds and real estate is a good thing because you can still get those higher returns, right? You're still getting an average return of anywhere from 12 to 15% on a lot of these alternative investments. But it's not correlated. It's not going up exactly or down exactly with stocks. So very, very big benefit there. Low liquidity is kind of a shortfall of a lot of these alternative assets. And again, the liquidity is just how quickly you can buy or sell or get in and out of an investment, okay? And there's going to be obviously differences in these different assets or these different investments within the alternatives. Obviously, something like Bitcoin or cryptocurrency, you can buy or sell it just as quickly as you could with a with a stock. There are some lag times, on some of the different crypto platforms like Coinbase and that kind of thing. Sometimes it takes a little bit to get your price in there, but generally, especially compared to maybe like real estate or some of these other investments that we'll talk about, it is very short. Whereas, the world where I come from, venture capital or angel investing, when you invest in some of these startup companies, these pre-IPO companies, usually there's a lockup period, and that works in private equity and sometimes hedge funds as well, where you might have a lockup period of 2 to 3 years or more where you're investing in your money and you can't take it out, okay? So obviously that is very, very illiquid right there. And then even after that lockup period expires where you can technically sell your investment, then again, it might take it might take a while to be able to find another investor to sell those shares or that investment in the alternative investment. Another characteristics are just higher returns here. And this is just kind of a trade-off between that risk and return, right? There is greater risk in a lot of these investments that we'll talk about, obviously specifically cryptocurrencies. We'll talk about NFTs and art, collectibles, and then those more traditional alternative investments like venture capital, private equity, and hedge funds. Okay, there's just much more risk in these investments. But, again, if investors are going to bear that risk, and the market is going to take that risk, then it's going to want a higher return, and that's what we see over the long run on those. The last characteristic we'll talk about here is kind of a less than perfect market pricing, and that's really important here, and really goes into a lot of your opportunity in these alternative investments, right? The stock market, you have millions of people, hundreds of millions of people analyzing stocks, analyzing bonds, pulling in all the news, all the available news, and sometimes even some of the unknown news, the non-public news that goes into insider trading and a lot of that. Sometimes even that is reflected in the current stock price of shares of the stock market. So it's almost perfect market pricing, right? And that just means that you're not really getting a deal on anything. The market prices in, it bakes in all that current news into those prices, as well as the expectations for cash flow. And if you ever want to know how perfect it is, then look at analyst expectations for earnings, right? And they're generally very close. Within 3 to 6 months, analysts pretty much know what companies are going to be reporting for earnings and bake that into those stock prices, right? By comparison, a lot of these alternative investments, they just don't have that perfect market pricing. Okay, when you're talking about, obviously cryptocurrency, Bitcoin, that kind of thing, still very much in the air of what the actual valuation should be on that. When you have these venture capital and angel investments in startups, still very much uncertain about what the valuation should be on a new company, a startup company, and that kind of thing. So really, as well as even traditional real estate, which, like I said, sometimes we talk about that in this realm of alternative assets, still very much imperfect market pricing, because it's more of a one-on-one transaction there between the buyer and the seller. It's not necessarily the entire market that sets the price on that on that piece of real estate. So you can get very good deals if you learn about these specific assets, these specific investments within the alternatives, and learn how to price them. Learn how to price them better than the market is doing right now. So again, great opportunity for that. So again, we're talking about, stocks, bonds, real estate are the three primary assets that most people follow, the three traditional assets there. And then you've got this alternative assets, right? And that's kind of just a lump of everything that's not included in these other three assets, right? So we'll cover, we'll cover 5 right here. Then we'll cover, why invest in those alternative investments, how much you should be investing, and then I'm going to share my own portfolio and kind of some of my thoughts and what I'm thinking on alternative investments as well. First, we have kind of private equity and hedge funds, right? And these are, just and they're different here, but I've kind of lumped them in together. Private equity is just basically a pool, a fund of rich people's money, right? And generally they'll go out and they'll try to buy up distressed companies a lot of times. They'll buy up companies and then load them up with debt, right? Called a leveraged buyout, right? They'll borrow billions of dollars to buy this company, load it up with debt, and then kind of try to turn it around, right? These are supposedly the guys that run these private equity funds. Them and the management they seek, they're supposed to be the masters of the universe as far as company management. So yeah, they'll go in something like you had with Kraft Heinz quite a few years ago. They went into that company, bought up the shares, took it private, took it away from investors, tried to, they leveraged it, put tens of billions of dollars in debt on there to kind of cash out part of their investment, tried to turn the company around, and then they issued shares again to investors and really cashed out the rest of that investment. Then you have hedge funds, which actually I have a video coming up in a couple of weeks about hedge funds, some of the strategies they use, long, short strategies, short focus strategies, a lot of different, complex investing strategies in different types of investments to produce those not just high returns but risk-adjusted returns, right? They'll try to get an investment strategy or a complex strategy out there that has almost zero returns or zero risk, right? They'll with that long short investment strategy, they'll buy shares of some companies, and then they'll sell shares of other companies within the same sector, the same industry, or even just to sell shares of the market, right? Or sell short the market in general, like the S&P 500 index. And what this does is it really takes the market risk out of those stock picks. Okay, so basically they're trying to remove all the market risk and only getting the returns from their stock picking ability. Okay. And of course, these hedge funds are managed by billionaires and with billionaires' money. So they're really putting their best foot forward to get those kinds of returns. Next, venture capital and angel investing, and again, this is kind of the world that I come from. Started my professional career out as a commercial property analyst, but then quickly jumped into the venture capital space, which is buying these companies or investing in these companies, these startup companies before they go public, and this is a great market for returns, right? If you think getting in on the best IPO is really the best returns, that's wrong, because those returns are already kind of bled out of those companies when they come to the market. Okay, and it's these venture capitalists, these angel investors that buy into the shares. People like Peter Thiel that made a 4,000% return on his investment in Facebook. He invested in it. He was actually the first private investor in Facebook. Okay, this was back in I think 2004, 2005 when he went to Mark Zuckerberg and the team there when it was just like a 3-person operation. Invested in the company before 10 years before anyone else could. And I think what Facebook went public there in maybe 2008, 2009, something like that, so right around there. And he made a 4,000% return on that investment. And that's that venture capital and angel investing idea. Typically returns for a lot of these. Okay, so for private equity hedge funds, you're going to get returns of between 12 to 15%. A lot of times the hedge funds tend to have a little bit lower return, actually, right around 8 to 10% or even lower, but they're risk adjusted returns. So again, they're removing a lot of the economic risk, a lot of the market risk out of these investing strategies. So investors that are investing in these hedge funds, they're willing to take that a little bit lower risk, even as low as 5 to 8%, because they're basically getting kind of those bond returns, right? Those very, very safe bond returns, except they're getting them, they're getting a couple percent more, and they're getting the bond-like safety. Okay, because of these strategies. Venture capital and angel investing portfolio returns on those actually are right around 27%, and that's a study that all you out in the Bowtie Nation know this study because I use it a lot. This is a great study on angel investing, over 3,000 angel investments in those startup companies. And over any 3 to 5 year period, they tended to rise 160%. Okay, so 2.6 fold times the investment across a portfolio of angel investments. And it annualizes comes out to be about 27%, which might not sound huge against the stock market over the last couple of years. Tesla up 700% last year. Bitcoin, all those runaway investments in the stock market over the last couple of years. But historically, over the last 30 years, 40 years, 27% is huge. Over the last 10 years, stock market has actually averaged 12% a year. Over the longer run, over 30 or 40 years, 50 years, stock market's only averaged about 8% a year. So if you compare that longer term average return on the stock market against a 27% annualized return, you really see the power of this venture capital, this alternative investment there that we're talking about. Cryptocurrencies, okay, and these are just this is just the whole gamut of cryptocurrencies, right? Between Bitcoin and Ethereum to Dogecoin and all the others. This is one of the harder ones to really put a return on, right? Because it is so volatile. If you just measure the returns over the last year or over that 2017 period, you would think average returns were on the order of 3 or 4 or 5 fold a year. But if you do look at the longer term, all the way back from 2009, 2010, all the way to current, The returns are still very good on an annualized basis. But it's hard to get that annualized return that you can say, okay, this is what we expect going forward. Um, but obviously, something that fits that alternative investment kind of framework, and we're going to be talking about that more in a little bit, because that's actually one of the bigger investments in my alternative investment portfolio. Um, Bitcoin actually come down quite a bit over the last since this week's peak. Actually, right today it was down as low as 53,500 in the U.S. market. There, I think in Asia it was something like 51,000, which is about 20% below its peak of this week from 64,000. Right, we had that momentum in Bitcoin all the way up to the Coinbase IPO. It was up to 64,000 per coin. So excellent return there, and then now it's down 20%. So obviously very volatile returns there. And a lot of people have blamed a lot of things for this. Turkey actually announced that at the end of this month they're going to start forbidding or prohibiting any payment in Bitcoin. Right? As far as I know, you can still own Bitcoin, but you can't pay for anything with Bitcoin, or can't transact. So that's been blamed for part of it. Part of it has been blamed on the kind of poor performance of the Coinbase IPO. Did very well, into the start of trading, but then came down that first day, went up a little bit that second day, but kind of a lackluster, kind of a buy the rumor, sell on the news on that Coinbase IPO. So maybe a little bit less enthusiasm for Bitcoin in that, but it also gives people a lot more options, right? The more options Bitcoin and crypto investors have to put their money in, different coins or different platforms or different things, then obviously it's going to kind of smooth out the demand for any one of those, in Bitcoin in particular. Now Bitcoin investors can invest in kind of the gatekeeper, right? They can invest in a platform that's providing the picks and shovels for this Bitcoin gold rush instead of the currency itself. So obviously that's going to take a lot of demand out of Bitcoin, and we'll talk about kind of the upside valuation on Bitcoin, that as well. Another asset that we can talk about is NFTs, those non-fungible tokens, as well as art. And I put these two together because I feel like they're very much related. A lot of these NFTs have been just artists selling their artworks through that NFT space, right? And so these are really interesting. Obviously, again, very illiquid. The NFT, even the auctions on the NFTs are very few and far between. It takes a while to get to sell or buy these, as well as traditional art. Traditional art, obviously, it's going to take much longer to buy or sell those. Much more of an imperfect market, right? Because a lot of that valuation is going to be subjective to the eye of the beholder, as well as just where the general art market is going. And then you've got collectibles. So returns on art tend to be from 10 to 12% over the long term. Okay, so what we've seen over the last 10 years, 20 years for art has been that return of about 8 to 12%, a little bit higher, maybe 10 to 12% annualized return on art. But again, it's very much a function of how well you can value the art personally, and what kind of opportunities you can find. Because just some layperson that doesn't know anything about art prices or returns or anything like that, going in just buying anything, they're likely to get lower returns on their portfolio. Whereas someone that takes the time to really learn, how art prices work, some of the best artists and the best potential in different artists, they're going to make higher returns, even 10, 12, even up to 15% on those. Then you have the other assets real quick. Collectibles, things like cars, comics, even wine, spirits. I've seen people sink $10,000-$20,000 or more into a single bottle of wine, or a single bottle of rum or whiskey, or something like that. And it's interesting. It's one of the biggest values out of a lot of these collectibles and arts, obviously, is just the conversation value. Okay, just the conversation starter that this bottle of wine you bought at $5,000 back 5 years ago, and it's now worth $10,000 or $20,000, right? So kind of those non-quantitative returns or values in some of these investable assets, in some of these alternative assets. We've already talked about a little bit about why invest in some of these these alternative investments, these assets. The pros are just really to diversify yourself away from those stocks, but still maintain that higher return. Okay, so a lot of people, they'll buy bonds, corporate bonds or treasuries or whatever for that safety and for that diversification away from stocks, for that safety for when stocks are crashing, bond prices are usually going up. So they'll buy some bonds for that safety and that diversification. Well, here you can put some of your portfolio towards alternative investments that aren't correlated with stocks and still get that same diversification, still get that same portfolio safety, but the higher return as well. So maybe you don't have to sacrifice quite as much of the return since, bonds are obviously much lower return than stocks. You don't have to sacrifice that return all the time just to get that diversification and that safety away from the stock markets and a potential stock market crash, right? You've also got that conversation starter with some of these. You've also got, just the ability to get that opportunities in the imperfect pricing, right? So you can go into some of these and really learn about that specific space of alternative investments like art, like even Bitcoin, which isn't a perfectly priced market right now, or the venture capital angel investing. You can go into these and learn everything you can about these alternative investments, learn how to price them better than anyone else, and you can get those higher returns. You can get those those outsized returns. That alpha really is what we talk about in the space. The cons, again, obviously here is very much a liquid. It might take you a month or 2 months or even longer to sell some of these assets, or you might have that lockup period of 2 to 3 years in some of these. So obviously that's something to think about. This is obviously something where you have to have the patience to be able to sit in a stock. And this is something we actually talk about a lot in our penny stock investments too, is you kind of have to treat those as venture capital sometimes. Give those companies room to run, time to run, and time to grow and prove out that investment theme that we're talking about. These are obviously higher risk. Like we said, Bitcoin was down 80% from its 2017 peak into the next year, and really held that was there for a long time. But even the people that bought in at $19,000 in that 2017 peak, even the people that got it at the price and were down 80% at one point over the next year, they're still up so they're still up threefold, right, on their investment to 60,000. If they've held it since 2017, since that peak, they've still made very good returns. So obviously there are opportunities here even with this higher risk. That imperfect market pricing can be a risk or can be a con as well if you don't know how to price these. If you're just jumping into some of these works of art or collectibles, if you think you're going to get rich on angel investing or some of these or Bitcoin without really taking the time to understand, okay, how does valuation work with this? What does the future look like on this? Did a Bitcoin valuation video a few weeks ago, and actually found that the longer term, the 3 to 5 year valuation was probably closer to the fair value, probably closer to 94,000 to 190,000. But that took some time to develop that valuation and that theme, that thesis around the user base, around the uptake of corporate cash as well as institutional investors. So, if you're not willing to take the time to really learn how to value some of these investments that have those illiquid, imperfect market pricing structures, then it could be a con because you could get taken. You could go into an art auction and pay way too much for a piece of art and never make a return on that because you just paid so much. There's also that less certainty of returns, right? As optimistic as I am on Bitcoin, then there is an uncertainty in that. You've got kind of the ban on mining in China. You've got the prohibition of Bitcoin in Turkey coming up, and if that expands outwards, the U.S. Treasury Department is now talking about kind of cracking down on the illicit use of Bitcoin. So you got a lot of uncertainty around these investments, and it can be, that's why you get the higher returns, is you've got that higher risk. So now, before I show you kind of an inside view into my own portfolio, what I'm holding and what I'm thinking about, then I want to talk about, how much to invest in these alternative investments, these assets, because, this is so important because I feel like a lot of people, they're seeing, Dogecoin, I think is up like something like 40-fold this year, just since the beginning of January. Out on Yahoo Finance is an article that says $1,000 in Dogecoin at the beginning of the year could now buy you a Tesla, right? So Tesla, about $40,000 right now. So you could buy a Tesla for $1,000 basically if you invested in Dogecoin at the beginning of the year. Bitcoin, multi several times your money on that over the last year. A lot of these alternative investments, especially the cryptocurrencies and others have just boomed over the last year. And I feel like a lot of investors are just rushing into these without knowing exactly what they are, how much they should have in their portfolio, or the risk behind them. Okay, obviously we talked about that crash in Bitcoin in 2017, 80% down from the top. And while those longer term investors, while the investors that had the patience and the guts, the intestinal fortitude to stick around in that alternative asset, they've done very well, 3x return or more, over the last 3 years. There were a lot of people that panicked and sold out at $4,000 or $5,000, losing that 80% of their money. And I just don't want a lot of you out there, that's rushing into these, maybe putting 100% of your portfolio in Dogecoin or in Bitcoin or, in these SPACs, these special purpose acquisition companies, putting 100% of your portfolio in those. And then, when we do get that risk and that sell off, then not panicking, not losing so much of your money that you're forced to sell and things like that. I see a lot of people every day in the comments talking about investments and stuff, and people are just like, just buy Dogecoin. That's all you need to know. Or just buy Bitcoin. That's all you ever need to retire rich and retire and all that. I think a lot of people out there are fully invested 100% in either Bitcoin or Dogecoin or GameStop or Tesla or whatever the investment du jour is, right? And then they panic. They think even with a hiccup in the market, NASDAQ was down 11% at the worst point in March after that sell-off, down 11%, and a lot of these high growth expensive meme stocks were down 30, 40, 50% even, so you can lose a lot of money in these. And that's why I say no more than 30% of your portfolio should ever be in this alternative investment group, right? And I'm talking about the entire group here, 30%, maybe even 35 at the most. So about a third of your wealth at the most in these investments. And that's probably pretty high for most people. I would say that's probably only acceptable for someone that's willing and able to take a lot of risk in their portfolio, has the patience, has that intestinal fortitude to sit through a crash of 40 or 50 or 60%, be able to hold on for that long-term thesis and for that long-term investment. Because again, if you're a great investing quote, and I can't remember quite who said it, I think it was Graham or somebody that said, if you can't imagine a 20% loss on your portfolio, a 20% crash in your investments, then you shouldn't be in the stock market. And I think you can say that just as well for alternative assets. If you can't imagine and live with a 20% crash or losing 20% of your portfolio overnight like that, okay, then you shouldn't be in these, or you shouldn't have more than 20 or 30% at the most of your portfolio. Okay, so what this is going to do is obviously, even if these alternative investments that you're in, even if the crypto or the the art or the venture capital or whatever you're investing in, even if those come down 20 or 30 or 40%, then you've still got that other 70% of your portfolio that's really, smoothing out your returns. Stocks are going up, bonds may be going up, real estate, whatever you might have in that 70% of your portfolio, that's really going to protect you from panicking and from being forced to sell out of these at the worst possible time. And beyond that, 30% total in all of these alternative investment ideas, I think you should have no more than 15% in any single alternative investment, right? So if you're planning on holding a third of your portfolio, 30% of your portfolio, so say you have $1,000 to invest. If you're planning on investing $300 of that, 30% of your money in these alternative investments, you need to have at least two of these that you're choosing from. Okay, do not have 30 or 40 or 50% of your money in Bitcoin alone. Okay, because you do have those risks. And again, I'm not saying that Bitcoin won't go up over the long term. What I'm saying here is that if you have more than that 30 or 40 or 50% in Bitcoin, if you have that much of your portfolio in one single alternative investment, and it does crash down 30, 50% or more, 80%, we could easily see an 80% crash in cryptocurrency, in Bitcoin. If it does that, then you're not going to panic if you have less than 30%, less than 20 or 15% in that one single investment, because your entire portfolio isn't going to look quite as bad, right? If you've got $300 of that $1,000 investment of that portfolio in Bitcoin, and it loses, if it loses 60%, right? So you're down $200. If the rest of your portfolio, that other 70%, is up 20%, so that would be you'd gain $140 on that portion of your portfolio. You're down $200 on your crypto or on your Bitcoin there, so you're really only down $60, right? Which is only a 6% loss. Okay, that's something that anyone can live with. Anyone can kind of stick it out and really not freak out, not panic about this, right? But again, if you've got 100% of your money in Bitcoin and it crashes by 65%, so you're down $650 there out of that $1,000 portfolio. You're pretty much down to nothing. You're cashing out to go to Vegas and see what you can do because you're stuck. You're done. Now, this is just kind of a general idea. Obviously, as you get older and closer to needing your money, then you're going to want less of your money in these alternative investments because they are illiquid. That means that you can't necessarily just buy or sell them very quickly. You can't sell out of that investment a lot of times very quickly. So, so we've got some spammers in here in the comments. I'm gonna put user in timeout, remove. Okay, folks. Anytime in the comments you see anybody, especially someone with my channel name that says call 1576, and buy Bitcoin, fuck them. They are the scammers. They are the lowest of the low, worst people in the world, and we need to bring back capital punishment for these assholes because they're just trying to take advantage of people. I will never post my personal phone number in the comments. Okay, I will never contact you in the comments and say call this number and try to sell you some kind of Bitcoin investment or something like that. Okay, so for the chat here, for any comments on any of the videos, don't be friggin' falling for these scammers and just report them as scammers anytime you see them. Anyway, back to that. Obviously, as you get closer to needing this money, you want more liquidity, not less. You want to be able to sell out of your investments as quickly as possible when you need that money. So obviously, these assets, these alternative assets are going to be a smaller part of your portfolio. You don't want that risk. You want that safety. You want that certainty of returns. So, if you're closer to investment, then you're going to be like closer to maybe 5 or 10% even at the most of your portfolio in these alternative assets. Okay. Now I want to talk about, kind of my portfolio, what I'm thinking right now as far as alternative assets. My exposure right now is actually pretty low. It's actually that 225,000 is split up. I've got about 150,000 in angel investments and penny stocks. And again, I kind of lump penny stocks in with this alternative idea. Even though they're liquid, they're stocks. They trade over the counter or whatever in stocks, but they are that longer 3 to 5 year lockup period that I think about when I think about venture capital, angel investing, those very risky startup companies that half of them might go bust. I honestly, to be honest with you here, half the penny stocks that you invest in could go bust, but you're really looking for those handful, maybe the 5 out of 10 penny stocks to do that 10 or 20 times return or more to really get you to that 27% annualized return, right? That's the annualized return on an angel investing venture capital portfolio. And it's because, you've got the losers there, but you stick around for 3 to 5 years, let those companies really play out and grow into those billion dollar unicorns that they can be. So I've got 150,000 in that, and that's the original investment value, right? I don't mark up my penny stocks or the penny stocks are that value, but the angel investments, the startup investments that I have that aren't really traded, you can get a current valuation every time the company goes for new funding or gets an offer from venture capital or whatever from that. But I generally just keep it at my own investment value. So maybe a little bit more in those than if I were to market all the way up to current valuation on those non-traded companies, those non-traded shares, things like that. I've also cashed out some of those over the last year. Been a great year for angel investing and startup investing and venture capital, just because so easy for a lot of these companies to come to the market with those SPAC companies with direct listings, things like that. That a lot of these startup companies have done that. They've taken advantage of the enthusiasm in the market, and and they're coming into the into the market so easy. So cashed out a lot of those over the last year. Crypto, I've actually got about 55,000 right now, split equally between Bitcoin and Ethereum. So obviously Bitcoin is the more popular cryptocurrency out there. It's got that momentum. It's definitely helped by platforms going IPO or direct listing because Coinbase raising $100 billion valuation, raising tens of billions of dollars in funding. They're going to put that money into marketing, right? They're going to put that money into bringing more investors onto the platform, buying Bitcoin, buying these other cryptocurrencies, and that's really going to be upward support for these cryptos. Bitcoin obviously definitely also has the support, the momentum from corporate cash, right? It's the most I don't want to say the most stable, but it probably is the most stable crypto out there. It's obviously got the most legitimacy of the cryptos, I think, maybe besides Ethereum. So a lot of corporations, we're seeing they're putting their excess cash in Bitcoin just as as an alternative to the U.S. dollar. Okay, it's also obviously got the institutional money that's coming into it. Some of these large banks, Bank of New York Mellon, the oldest bank in the United States, actually just over the last couple of months is allowing their investors, their larger investors, to hold Bitcoin in their accounts. So Bitcoin's got that that momentum and that popularity. Like I said, we did a video a few months ago, valuation of Bitcoin. I think over the longer term, considering the user base, considering the institutional capital and all of this, between 94 to 190,000, and that's probably kind of a low estimate, kind of a conservative estimate, because me, I'm a pretty conservative investor, and even that, that 94,000 over today's $54,000 Bitcoin price, that's a pretty darn good return. Even if it takes 3 to 5 years, even if it takes 3 years to reach that 94,000 low estimate, then that's a pretty good price. I like Ethereum a little bit better though, actually. And if you look at returns over the last 5 years, 3 to 5 years, Ethereum has really blown the doors off Bitcoin. And I think as the blockchain becomes a bigger part of corporate software, of what corporations are doing, as the trend moves more towards using the blockchain, then I think Ethereum really has the advantage here. They have more developers on the Ethereum platform using that. We've already seen, JP Morgan does something like $5 trillion in foreign exchange transactions every day. And they use the Ethereum platform to create their own JP Morgan dollar, right? Their own crypto on that. So you get much more corporate buy-in and corporate use of the Ethereum platform. And I think that's just going to support that token, in the future a little bit more than Bitcoin, which is really kind of just right now, just the investment value, maybe a little bit of the transaction value. And in the future, it'll have more transaction value. But I think Ethereum is really where you want to be as far as the future of crypto and that kind of thing. Miscellaneous collectibles, I've got 20,000 in some fine art and actually some comics back when me and my dad used to collect comics. So not a whole lot in there, a few paintings and stuff that I think can do well over the next 5 or 10 years. As well as just kind of the diversification. I love holding these comics as a conversation piece, or because I love that universe of comics so much. And this is actually about this whole 225,000, right, between the angel investments, the crypto, the collectibles, miscellaneous collectibles. Actually, about 10%, a little under 10% of my total portfolio right now. Again, after exiting a lot of those, some of those angel investments over the last year that have either been bought out, been acquired, been bought out by venture capital firms, or have just gone public. So exited out of some of those. Again, very strong year for those kinds of investments. I'll continue to add to my cryptocurrency exposure, probably, especially if the price of Bitcoin falls below 50,000, because I do have that long-term outlook. But I am hesitant here about kind of that angel and venture capital space, just on valuations right now, right? It is, like I said, it's been so easy for companies to list through an SBAC, through a direct listing. It has been so easy for them to come to market and raise those billion-dollar valuations that the valuations on a lot of these are very high right now, and probably not supportive of just basic fundamentals. So that's kind of where I'm standing right now, right? I still do have some of those angel investments, as well as the penny stocks that we talk about on the channel there. Actually doing a penny stock video on Wednesday covering the whole portfolio of the stocks that I've been tracking over the last 2 years, since December of 2019. Been following about 39 penny stocks that we've been recommending on the channel, actually up an average of 60% over that period. So great return there. And talking about kind of some of the penny stocks that have actually fallen from those initial reactions or initial recommendations, and what I'm doing with those, why I'm still holding some of those. A lot to do with that longer time horizon, just letting these companies play out. But still doing very well on those penny stocks, the crypto, the collectibles as well. So now I want to turn it over to the Q&A section and talk about your